Porsche did something in 2026 that looked, at first glance, like a complete contradiction. It backed away from the electric-only future it had spent years promising, redirected money toward gasoline and hybrid vehicles, pushed major EV programs further out, and then, in the same strategy shift, confirmed that two entirely new electric sports cars were still moving forward. That sounds confused only if you accept the headline version of the story. Porsche is not quitting electric cars. It is quitting something much bigger. The idea that a car company has to choose one technological future, bet everything on it, and pray that customers arrive on schedule. In July 2026, CEO Michael Leiters made the new direction clear. Porsche would reduce its dependence on battery electric vehicles, restore investment in combustion engines and hybrids, and stop treating one powertrain as the inevitable answer to every segment. The reason was painfully simple. Demand had not developed the way Porsche expected. The EV price war had become brutal. China had deteriorated, and the financial damage had become impossible to ignore. This was a company that once targeted roughly 80% electric sales by 2030, invested billions around that assumption, and built an enormous portion of its product strategy around an electric transition happening quickly. Instead, the electric flagship underperformed, China collapsed, and profit fell by more than 90% in a year. That was the wreckage Leiters inherited. So when Porsche revealed that its coming K1 flagship SUV would arrive with a gasoline V8 before the electric version, confirmed combustion engines would remain deep into the next decade, delayed the fully electric Panamera, and stepped away from a software partnership with Rivian, the conclusion almost wrote itself. Porsche had surrendered. The EV experiment had failed. Gasoline had won. Except there was one problem with that narrative. Porsche simultaneously protected the battery-electric 748 Boxster and Cayman. Those cars are still coming, and that detail changes the meaning of everything. Because if Porsche genuinely believed electric performance cars were a dead end, those projects would be obvious cancellation targets. They are specialized sports cars. Development is expensive, volume is limited, and Porsche could easily justify killing them under a retreat narrative. It did not. Instead, Porsche preserved them while reversing course elsewhere. That means the company is not fleeing electricity. It is building a hedge, and that hedge may be far more important than any single model Porsche launches over the next decade. For years, the automotive industry operated under an unwritten rule: pick the future early, commit hard, scale faster than everybody else, and never show doubt. Tesla made conviction look powerful. Investors rewarded companies for publishing dramatic EV deadlines. Executives competed over who could promise the fastest exit from combustion. Porsche embraced that logic with unusual intensity because it seemed uniquely capable of making the transition work. Strong margins gave it investment capacity. Its engineering reputation was almost unmatched. Its brand could command premium pricing. It had already demonstrated that buyers would accept an electric Porsche. If any traditional manufacturer could force an all-electric transition onto its own timeline, Porsche looked like one of the safest bets in the industry. And that is exactly why what happened next matters so much. Porsche discovered that engineering excellence cannot manufacture customer demand. Brand prestige cannot force charging infrastructure to mature faster. A strategy department cannot make buyers in Europe, America, and China all want the same technology at the same moment. And when a company designs factories, sourcing, software development, batteries, platforms, suppliers, and model plans around one fixed forecast, being early can become almost as dangerous as being late. Porsche did not necessarily misread the long-term direction of transportation. Electric vehicles may still dominate over time. What Porsche misread was the certainty and timing. Those are two completely different mistakes. Now look at the first half 2026 sales data, because this is where the strategy stops being theoretical. Porsche's total deliveries fell 16%. That sounds terrible until you separate the models. The 911, the oldest and most unapologetically combustion-driven car in Porsche's lineup, grew 19% globally. In the United States, 911 sales surged 56%. Meanwhile, the fully electric Taycan fell another 25%. Same manufacturer, same economic environment, same 6-month period. One of Porsche's most traditional gasoline cars was accelerating while one of its most important electric products continued shrinking. That does not prove gasoline wins forever. It proves something much more uncomfortable for automakers. Customers are not moving in one clean direction. Different segments are moving at different speeds for different reasons in different countries. Porsche's old strategy required those customers to converge. Its new strategy assumes they may not. And then came the financial number that made the shift harder to dismiss. Despite selling fewer vehicles and still facing serious weakness in China, Porsche's operating profit climbed 34% to more than €1 billion. Operating margin improved from 5.5% to 8%. Think about what that means. Fewer deliveries, but more operating profit. Porsche stopped treating volume as the scoreboard and started treating mix and margin as the priority. Leiter's philosophy can be reduced to a brutally simple idea. Make more money from fewer cars. Do not chase Tesla for volume simply to prove strategic purity. Do not build electric vehicles just to satisfy a percentage target. Sell combustion cars where customers still want combustion. Sell hybrids where hybrids solve the problem better. Sell electric vehicles where electric genuinely strengthens the product. Protect the brand, protect pricing, and protect profitability. That is not anti-EV thinking. It is anti-dogma thinking. And Porsche's early financial improvement suggests the market may reward that flexibility faster than many expected. The reason every competitor should be watching is that Porsche was almost the perfect test case for the all-electric legacy brand thesis. It had decades of engineering credibility, unusually high profit per vehicle, global recognition, loyal customers, premium pricing, and an early electric head start. If a traditional automaker could absorb the cost of transition, create desirable EVs, and carry customers with it, Porsche should have been near the top of the list. Yet even Porsche ran into the same wall, confronting the entire industry. Technological possibility is not the same thing as commercial timing. Billions can be invested in factories before volumes appear. Battery supply chains can be assembled for demand that arrives years late. Software programs can absorb staggering amounts of capital while customers compare the finished product with companies that grew up as software businesses. Suppliers can fail. Porsche even saw a battery partner collapse. Fixed infrastructure built around optimistic forecasts can become dead weight incredibly quickly. This is the lesson other automakers are now absorbing. The strategic error was not believing EVs would matter. The strategic error was constructing the company as if nothing else could matter, and Porsche is hardly alone in changing course. Mercedes once discussed an electric-only future in markets that allowed it by the end of the decade, but now plans to keep combustion engines alive well into the 2030s. Audi abandoned its rigid deadline for ending new combustion launches. Volkswagen has extended the life of gasoline and hybrid products even after making one of the industry's biggest electric commitments. In the United States, Ford and General Motors delayed programs and reduced billions of dollars of EV spending after electric divisions generated enormous losses. The pattern is becoming difficult to ignore. During the early 2020s, automotive executives competed to announce the strongest electric targets. By the middle of the decade, many of those same companies were quietly rebuilding flexibility into their plans. Porsche is simply making the logic more visible. It is saying that a manufacturer does not need to predict one winner today. It needs an industrial system capable of surviving whichever technology customers choose tomorrow. That sounds less dramatic than declaring that every future car will be electric, but from a capital allocation perspective, it may be far more intelligent. It also explains why Porsche can launch a gasoline K1, continue hybrid development, preserve the combustion 911, and simultaneously spend money on electric Boxster and Cayman models without contradicting itself. Those products are not competing philosophies anymore. They are insurance policies against uncertainty. The difficult part is that flexibility does not magically solve Porsche's deeper problems. The company is still trapped between multiple customer groups whose expectations are moving apart. Traditional Porsche buyers want mechanical character, engine sound, tactile feedback, and the emotional identity built over generations. Newer luxury buyers increasingly expect software quality, rapid charging, seamless connectivity, advanced digital interfaces, and technology comparable with the best Chinese EV makers or Tesla. Porsche has to serve both without becoming mediocre at either. That is a much harder challenge than simply choosing one drivetrain. In China, the problem is especially severe. Domestic manufacturers have moved with extraordinary speed in software, features, pricing, and electric technology, While Porsche's premium positioning has lost ground, the hedge does not automatically restore Chinese demand. It does not fix software overnight. It does not reduce costs by itself. And it does not guarantee that customers who felt Porsche moved too far away from its enthusiast roots will immediately return. What the new strategy gives Porsche is time. Instead of forcing every market and every buyer into the same technology cycle, it can make money from the 911 enthusiast, develop electric sports cars for early adopters, use hybrids as a bridge, and adjust product investment as actual demand becomes visible. That is not a cure. It is a way to fight from a stronger position, and for buyers, this shift has practical consequences. If you love combustion engines and believed you had to rush into one of the last gasoline performance cars immediately, Porsche's decision is a strong indication that the timeline is stretching. Porsche is keeping combustion alive into the next decade, and Mercedes, Audi, Volkswagen, and others are making similar adjustments. Gasoline is not disappearing on the schedule many people assumed a few years ago. That does not mean regulation stops, emissions rules vanish, or combustion remains dominant indefinitely. It means manufacturers now see enough continued demand to justify more investment and a longer runway. If you are considering an EV, the lesson is not that electric cars are a bad purchase. Porsche itself is still developing new electric products. The lesson is that electric technology is evolving rapidly enough that automakers no longer want their entire businesses locked to today's economics, batteries, charging speeds, software, and resale assumptions. For a consumer, that makes the ownership question more complicated. A newer EV 2 or 3 years from now may offer better charging, lower cost, improved range, stronger software, or some combination of all four. That does not automatically mean you should wait, but it does mean leasing may deserve more consideration when technology is depreciating and improving this quickly. There is also a broader ownership risk that rarely gets discussed. A car is only as useful long-term as the ecosystem supporting it. Dealers, parts, software updates, warranties, resale confidence, and manufacturer stability all matter. In an uncertain market, a company that can earn money across multiple powertrains may be more resilient than one whose entire financial model depends on a single forecast being correct. Porsche is effectively buying itself optionality, and optionality has real value when nobody can confidently predict where the market will be in 5 years. The next major test comes with Porsche's Strategy 2035 presentation, expected at a major investor event in October. That is where management will have to turn this philosophical shift into specific commitments. Watch how many electric models remain in the plan and how quickly they are expected to arrive. Watch whether Porsche presents a credible route back into China or begins treating that market as structurally smaller. And watch the margin. The first half of 2026 showed operating profit above €1 billion and an 8% margin, but one strong period does not prove the turnaround is complete. If profitability keeps improving while Porsche maintains electric development and extends combustion and hybrid programs, the hedge begins to look like a durable strategy. If profits slip again and investment becomes increasingly fragmented, critics will argue Porsche simply traded one concentrated bet for an expensive collection of compromises. That is the real unresolved question. But zoom out, because the biggest change has already happened. Porsche has made uncertainty acceptable. For years, admitting uncertainty about the EV transition was almost forbidden in automotive boardrooms. Companies were expected to project confidence, publish deadlines, and speak as if the destination and timing were already known. Porsche is now saying something different. Maybe the future is mostly electric. Maybe hybrids remain far more important for longer than expected. Maybe combustion survives in premium niches for decades. Maybe different regions end up with completely different mixes. Instead of pretending to know, Porsche is designing a company that can respond, and that is why the headlines calling this an EV surrender miss the real story. Gasoline did not suddenly defeat electricity. Electricity did not suddenly fail. Porsche discovered that certainty itself was expensive. It went almost all in on one timetable, watched demand diverge from the plan, suffered enormous financial damage, and then rebuilt its strategy around never having to make that kind of one-way bet again. The electric 7118 survives because Porsche still believes electric cars have a place. The V8 K1 exists because Porsche now accepts that combustion has a place too. Hybrids remain because millions of buyers may want something between those extremes. What Porsche killed was not the electric future. It killed the requirement that there be only one future. And if this strategy keeps restoring profit while preserving customer choice, other automakers will have little choice but to study it. So the debate is no longer whether Porsche has turned against EVs. It clearly has not. The better question is whether refusing to pick one side is now the smartest decision in the automotive industry, or whether Porsche has been burned so badly that it has become afraid to commit. If the company that had money, engineering credibility, brand power, and one of the strongest early electric positions still could not force the market onto its preferred timetable, what exactly makes anyone else think they can? That question is now hanging over every automaker making billion-dollar bets on what will sit in your driveway next. Porsche has given its answer: build for multiple outcomes, follow the customer, protect the margin, and never confuse a forecast with a guarantee. Whether that becomes the playbook that saves Porsche or simply buys it a few more years is what makes the next chapter so important. And if you think Porsche just made the smartest move in the business or the most cautious move from a company that lost its nerve, drop your take in the comments. The headlines say Porsche abandoned the future. The evidence says Porsche may have finally stopped pretending it could predict it.